We've seen the 1% rule, we've seen the BRRRR, we've seen the single family duplex conversion, and we figured out how to creative finance all of these different types of projects. Moving forward, the one thing we want to talk to you about today is multifamily assembly and how we can get you financing on these projects.
Hey guys, Josh and Aaron back with another Finance Friday, and in today's video we're going to discuss a small multifamily assembly. Now this strategy wasn't necessarily something that picked up steam until recently when people started to realize that you can utilize CMHC financing on properties as long as there's more than 5 units involved and the properties need to be adjacent to each other. And once people figured that out, they were using the same principles that you use for normally turning over a repositioning multifamily building, but they're then looking to utilize it for purpose-built duplexes, side-by-side triplexes, new construction developments. If you pour in a little bit of the new zoning allowances that are allowed for increased densification and you add the strategy in, there's a bunch of people who are using this information to their advantage.
Yeah, and especially with the zoning changes that have happened where you can have up to 4 units on a lot now, guys are going out there buying these deep lots or really wide lots, severing them, building side-by-side fourplexes. And again, like Josh said, anything that's side-by-side adjacent over 5 units, you can then go and get either commercial financing or CMHC commercial financing, which has quite a few different advantages to being able to do it. One of the biggest advantages that we see is obviously how you value a building. If you take a look at a fourplex or a triplex and you go to get it appraised, that building is going to be based off of comps in the area. 3 and 4 unit buildings are probably one of the hardest to get appraised right now because there's not as many good comparables as of lately, just given the market. So they go out there and really get you the value that you're looking for. I mean, we've seen this kind of all across Ontario, to be honest, just in terms of clients that are buying. And I've seen issues with it over the last couple of years in Toronto area specifically, just given the comparables of a real legal fourplex or triplex compared to a 3-unit building that has a legal single unit, and then there's 2 illegal units that are added in there, and the comps are just messy. Whereas if you take this into a commercial type structure and you get it appraised through a commercial appraiser, well, he's taking a look at it from a net income approach and a cap rate perspective, which when you start to take a look at the differences, gives you quite a bit of an advantage on your value compared to a residential approach. Especially
when you're able to get 100% turnover in the buildings. And one of the main challenges in purchasing multifamily buildings in Ontario is vacancy. If the value is determined by net operating income, then unfortunately the issue with being able to increase the value is strict tenant laws in place. So the ability to purchase a small multifamily is much more common than it is to be able to purchase like a larger multifamily that has a ton of vacancies. So what we're seeing is a lot of investors purchase maybe these, as you said, double wide lot fourplexes and then adding another fourplex beside it to be able to achieve the 8 units or to buy side-by-side triplexes. The increased densification allows for creative ways for investors to be able to puzzle piece together multiple multifamilies now to be able to take advantage of the increased value add, but also the flexibilities and insurance flexibilities that CMHC now offers. Yeah, and it doesn't necessarily have to be all attached type properties. So for example, I have a client that's building some properties side by side, or I guess he purchased 2 pre-existing properties that were side by side, but he built a garden suite in the back. And the combination of the 2 duplexes on the front plus the 2 garden suites, that put us at 6 units overall. So, it doesn't necessarily have to be a fully structured 3-unit building, 4-unit building. You can start to get creative with these garden suites. And again, as long as everything is legal from the commercial standpoint, we can get it appraised and the commercial lenders will take a look at it. So, there's quite a few different ways that you can start to get creative in this, especially when you're taking a look at Toronto and allowing for laneway homes. Toronto's even allowing for potentially up to 6 units on a lot. So, there's going to be quite a few changes that I think are going to be coming down the pipeline. They're going to make this strategy even more crazy in terms of the benefits that you get out of it. But
I think as we're moving forwards and we're seeing people wanting to take advantage of the CMHC and taking advantage of commercial financing, especially with how much they've been struggling to purchase on the residential side and in their personal name, I think people once they understand this, we're going to start to see more people starting to target these types of purchases and trying to strategically buy these properties that are side by side.
What's amazing is it's not like you just have to buy something with like a walkout basement. Like this can happen with any side by side lot now. As long as you own both lots beside each other, you can add additional units on, whether it's a laneway suite, a garden suite, an ADU, an addition. You're going to be able to do those things to be able to then equate to 5 units total overall. And with the ability to be able to refinance based off loan to value because they're pre-existing, this is essentially the BRRRR that everybody was doing with the duplex conversions back in the day when the numbers worked. It's going to be acquire both lots or a big lot and sever it, do the work, get the 5 units, and then restructure with commercial debt. The advantage of this, though, is the fact that you can infinitely scale. You can do it in a corporation. You can get CMHC financing on the takeout to be able to get all your money back, plus some, depending on the financing options. It allows you to do it in any market in the country. CMHC will finance any market in the country as long as it's insured. So the opportunities are really immense with this new strategy coming out. I don't think people quite understand the impact that this is going to have on the real estate investor landscape.
Yeah, and the biggest misunderstanding or knowledge gap is just simply how much more beneficial it is to have an appraisal based off your cap rate and the net operating income versus that comp. And when we were having a hot market and everything was selling $100,000-$200,000 asking or over asking, it didn't really matter. The comps were abundant. But in today's market where the inventory is sitting and the sales volumes are down and things are moving for under, when they're moving for under listing price and stuff like that. Like, it's been a tough market to have comps in, especially if you're building or buying these multifamily. So I think, understanding the difference and how much of a value jump you get when you start to take a look at a net operating income approach, what these multiple units and when you're able to get these things turned over, it definitely makes up for a big difference. And in a market, especially too, where investors are relying on private investor type capital, and they're really looking for a way to get all that money back. Targeting something like this, it's going to give you such a big value jump and equity jump. Is going to be a good way to be able to, ensure that at least you get to keep a little bit of piece of that pie, and you're not just paying back all your investors.
Yeah. So realistically, how does this work? I mean, you got a few options available. You figure out how many units you're going to have, whether it's the minimum of 5, you got duplex, garden suites in the back, or triplex. You can be new construction, you can be pre-existing. The intention here is to underwrite the deal at the start of the project. So, get an as complete valuation. Your as-is valuation is most likely going to be a residential appraisal based off of the 2 residential lots, and an as complete appraisal based off of the actual projected net operating income of this unit, or the as complete value of these buildings assemblies together. And then what you're going to do is you're just going to figure out based off of a capitalization approach, as Aaron said, your appraiser is going to determine what the value is going to be based off of how it's going to operate at the end of the project. There are a few different ways that you can go about qualifying for the actual renovation or construction, depending on what you're looking to do. There are some intricacies involved if you are looking to go CMHC versus standard CMHC, or MLI CMHC versus standard CMHC. So just keep that in mind if you are looking to go MLI. The energy efficiency points are capped at 50 points now, but the standard financing options are still available to you if you are looking to do that. These are great ways to be able to access on the as complete value of the asset, not the loan to cost. Now there are some intricacies if you are looking to have a pre-existing building and then build something beside it. We ran into this recently with one of our clients where for the energy efficiency upgrades, for new construction, it's based off a percentage above code. And for pre-existing, it's based off of an increase from the baseline. Each building would be measured actually off of both. The first would be a percentage above national building code for the new constructed property, and the second would be the increase from the baseline. So keep in mind that you would have to meet both those requirements. So, when you are looking to acquire a pre-existing building and you want to add another one, there are some things you should be aware of as well. Another advantage of this type of financing or this strategy of financing is that there are multiple different renovation and construction options available. Depending on what you're looking to do, if you have separated lots, you are able to separate the debt that you're going to have on that initially when acquiring the property. So you might be able to have conventional financing on the pre-existing house and then construction debt on the house beside it. and then at the end you can recoup and restructure the debt into a single loan with CMHC. And now that the requirements around non-NHA approved debt, paying out private debt, there's so many more flexible options available to the market now to be able to allow you to increase the densification on these two lots. This was a major change with CMHC made previously, which is going to be a game changer moving forward.
Yeah, I think as investors, when you're sitting down and you're determining how are you going to build your wealth and how are you going to be successful, it's following the policy changes that come, and with this new zoning policy change and being able to get these things done, the financing structuring isn't new, but the new policy changes of how many units you can have on a lot is new. I think this creates a pretty large amount of opportunities for investors to come, and being able to sit down and understand this and take advantage of this. I think this is where a lot of mid-level guys are going to have the success. It's not going to be in the 50, 60, large scale type development. It's going to be sitting and getting into these types of projects where you can get in and out of the whole thing in under 2 years. You can do your construction, your renovation, your BRRRR, and be refinanced out in 24 months. Whereas on a larger project, you might not even have permits, or you still might be just figuring out the due diligence at 24 months. So the expediency and the ability to scale and the ability to efficiently get in and out of these is tremendous.
And that's the name of the game, is cost of capital and expediting the process to be able to get out. If you're doing a project without needing to get site plan control approval under 10 units and you're able to get a shovel in the ground as fast as possible, that seems to where all the money is being saved right now. So focusing on where the policies are changing, which way the wind is blowing in regards to where the capital is being allocated, where's the cheapest capital being allocated, how fast can you do the project, how profitable are you going to be. Looking at these secondary markets, even the GTA, it's working still. Like, the numbers work if you're looking for long-term holds and to recoup the majority of your capital back. The phenomenal thing about specifically CMHC is that it allows you to take on that leverage once fully stabilized. So you do reduce your risk because you have a fully stabilized asset. So again, Aaron and I say this all the time, reiterating, your requirement to know how to move in and out of different types of capital is the most important thing right now in today's climate. You are going to need to acquire, possibly privately, get some construction financing, renovation capital, learn how to project out your pro forma based off of maybe a different valuation model, and then determining what type of financing you're going to need at the back end of your project. So if you are looking at taking on one of these types of projects, feel free to reach out to an expert who knows how to navigate. Yeah,
guys, like we said, I think this is going to be one of the best strategies that's going to get implemented over the next 5 years with these zoning allowances and the regulations changing. So if you're looking for the next type of thing to get into and you're kind of sick of investing in the single family homes, reach out to us. Let's book some calls, have some conversation about what we're seeing and how it's working. And let's see if this is going to be a great strategy for you moving forwards.
Yeah, if you guys enjoyed this video today, we'd really appreciate it if you hit the like button, hit the subscribe button. Allows Aaron and I to do this and make more videos like this for you every single week. Our contact information is down below. Feel free to check out our website or contact Aaron and myself directly. We're always available to chat about your next project.